The dealers are making emergency calls right now, not to their usual clients, not to the big institutional buyers. They're calling each other, and what they're saying should concern every American who's been watching precious metals from the sidelines. I've been tracking this market for over 2 decades, and I've never seen anything quite like what's unfolding right now. The physical supply situation has reached a critical threshold. We're not talking about a temporary shortage or a brief supply disruption. We're talking about a fundamental breakdown in the delivery system that's been holding this market together. Let me paint you a picture of what's happening behind closed doors. Major dealers across the country are reporting the same thing. Their wholesalers, the people who supply them with physical metal, are going dark. Phone calls aren't being returned. Order confirmations that used to take hours are now taking days, if they come at all. And when they do get through, they're hearing the same message over and over. We can't guarantee delivery timelines anymore. Think about what that means. These are businesses that have operated like clockwork for decades. You place an order, you get a delivery date, the metal shows up. That's how it's always worked. But that system is breaking down right now, in real time, and most people have no idea it's happening. The spot market is showing one thing, but the physical market, the actual metal you can hold in your hand, is telling a completely different story. We're seeing premiums explode across every product category. Silver eagles that were trading at reasonable premiums just weeks ago are now commanding prices that would have seemed absurd 6 months ago. And it's not just retail products. Even wholesale bars, the kind that move between vaults and never see daylight, are trading at premiums that suggest something fundamental has changed. Here's what's really interesting. The paper market, the futures contracts traded on the COMEX, they're still functioning normally. You can buy and sell contracts all day long, but try to stand for delivery. Try to actually take possession of physical metal, and suddenly you're in a different world. Delivery delays are stretching out. Some contracts are being settled in cash instead of metal. The people who run this system are doing everything they can to keep it looking normal, but the cracks are showing. I want you to understand something crucial here. This isn't about price manipulation or conspiracy theories. This is about basic supply and demand reaching a breaking point. For years, the paper market has been able to satisfy demand without requiring actual physical delivery. Most traders never intended to take possession anyway. They were just speculating on price movements. But something has shifted. More and more buyers are demanding physical metal, and the system wasn't built to handle that kind of sustained physical demand. Before we go further, I need to mention something quickly. If you're watching this and you're concerned about protecting your wealth, I've put together a free guide that shows the saving secrets thousands of American retirees are using right now. It's in the description below. No obligation, just information that might be valuable given what's happening in these markets. Now let's talk about why this is happening now. The silver market has been in a structural deficit for years. That means industrial demand plus investment demand has exceeded new mine supply. The gap has been filled by above-ground inventories, recycling, and other secondary sources. But those sources aren't infinite, and we're starting to see what happens when they run low. Industrial demand for silver has been climbing steadily. Solar panels, electric vehicles, 5G infrastructure, medical applications. These aren't discretionary uses. You can't build a solar panel without silver. You can't manufacture the electronics that power modern life without it. And as the world pushes toward electrification and renewable energy, that industrial demand is only going to increase. But here's where it gets really interesting. Investment demand is surging at the same time, not just from retail investors buying coins and bars. We're seeing institutional money flow into silver ETFs at rates we haven't seen in years. Central banks around the world are diversifying their reserves, moving away from dollar-denominated assets. And while gold gets most of the attention in that story, silver is coming along for the ride. The gold-to-silver ratio tells you a lot about what's happening. Historically, this ratio has averaged somewhere around 60 to 1. That means it takes 60 ounces of silver to buy 1 ounce of gold. But that ratio has been all over the map in recent years. When it spikes up to 80 or 90 to 1, that's usually a signal that silver is undervalued relative to gold. And when it compresses down to 50 or 40 to 1, that's telling you silver is catching up. Right now, we're seeing that ratio compress in real time. Silver is outperforming gold on a percentage basis. and that's attracting attention from traders who understand what that means. When silver starts moving, it tends to move fast. The market is smaller, more volatile, and more prone to explosive moves. We saw it in the early 80s. We saw it again in 2011, and we might be seeing the early stages of another major move right now. Let me tell you about what happened in 1980 because there are some eerie parallels to today. The Hunt brothers, a wealthy Texas family, decided they wanted to corner the silver market. They started accumulating physical silver and silver futures contracts. As word got out about what they were doing, other investors piled in. The price went from around $5 an ounce to over $50 in a matter of months. It was a spectacular rise and an equally spectacular crash when the exchange changed the rules and forced liquidation. But here's what most people miss about that story. The Hunt brothers were able to do what they did because there was a fundamental supply-demand imbalance in the market. Industrial demand was strong, mine supply was constrained, and when a large buyer came in and started accumulating aggressively, the market couldn't handle it. The infrastructure wasn't there to deliver that much physical metal that quickly. Sound familiar? We're not dealing with the Hunt brothers today, but we are dealing with a market where supply is tight, demand is strong, and the delivery infrastructure is showing signs of stress. You don't need a single large buyer trying to corner the market when you have thousands of smaller buyers all trying to take delivery at the same time. The COMEX warehouse stocks tell part of the story. Registered silver, the metal that's available for delivery against futures contracts, has been declining. Not dramatically, not in a way that would trigger immediate alarm bells, but steadily, consistently, over time. And when you combine that with the delivery delays we're seeing in the physical market, it paints a picture of a system under pressure. Now I want to talk about something that doesn't get enough attention, the mining side of this equation. Silver doesn't come out of the ground easily. Most silver is actually a byproduct of other mining operations. You're mining for copper or zinc or lead, and you get silver as a secondary product. That means silver supply doesn't respond to price the way you might expect. Even if silver prices double, you can't just open up new silver mines overnight. The lead times are measured in years, not months. And here's the kicker. Many of the world's largest silver deposits are in politically unstable regions. Mexico, Peru, China. These aren't places where you can count on smooth, uninterrupted production. Labor disputes, environmental regulations, political instability. All of these factors can disrupt supply in ways that are hard to predict and harder to plan for. The refiners are another bottleneck in the system. Even if you can mine the ore, you need to refine it into the bars and coins that investors want. And refining capacity is limited. During periods of high demand, refiners get backed up, lead times extend, premiums rise. We saw this during the pandemic when retail demand surged and refiners couldn't keep up. We're starting to see similar dynamics now. Let's talk about what this means for the average person watching this video. If you've been thinking about adding precious metals to your portfolio, the window for easy access might be closing. Not permanently, but temporarily. We could be entering a period where physical metal is hard to source, where premiums are elevated, where delivery times are uncertain. That's not a prediction. That's what's already happening in parts of the market. The question you need to ask yourself is this: do you want to be trying to buy physical metal when everyone else is trying to do the same thing? Or do you want to position yourself before the crowd realizes what's happening? Because once the mainstream catches on, once the financial media starts running stories about silver shortages, the premiums are going to go through the roof. The dealers who still have inventory are going to charge whatever the market will bear. And if you're late to the party, you're going to pay a steep price. I've seen this movie before. In 2008, during the financial crisis, there was a brief period where you simply couldn't buy silver eagles at any price. The mint stopped producing them because they couldn't source enough blanks. Dealers had waiting lists months long. And when supply finally came back online, the premiums were astronomical. People who had positioned themselves before that shortage made out very well. People who waited paid dearly. Here's something else to consider. The relationship between the paper market and the physical market is changing. For years, the paper price has led the physical price. Futures contracts would move, and physical premiums would adjust accordingly. But we're starting to see instances where the physical market is decoupling from the paper market, where physical metal is trading at significant premiums to the spot price. not because of manufacturing costs or dealer markups, but because of genuine scarcity. What happens if that decoupling becomes more pronounced? What happens if the paper market says silver is worth one price, but you can't actually buy physical metal at that price? That's when things get really interesting, because at that point, the paper price becomes somewhat meaningless. The real price is whatever someone is willing to pay for actual physical metal they can hold in their hand. The central banks understand this. That's why they hold physical gold in their vaults, not gold futures contracts. They understand the difference between a claim on metal and actual metal. And increasingly, sophisticated investors are coming to the same realization. Paper promises are only as good as the institution making the promise. Physical metal is no one else's liability. Now, if you're sitting on retirement accounts worth $100,000 or more, there's something you should know about. Gold IRAs allow you to hold physical precious metals inside a tax-advantaged retirement account. It's a way to get exposure to physical metal without the tax consequences of liquidating your existing retirement savings. I've put together information about how this works in the description below. It's worth understanding your options, especially given what's happening in these markets right now. The geopolitical situation, the potential for market disruptions, the ongoing concerns about inflation and currency debasement. These are the kinds of scenarios where physical precious metals have historically provided a hedge. Not financial advice, just something to be aware of as you think about protecting your wealth. Let me bring this back to the immediate situation, the 72-hour window I mentioned at the start. Here's what I'm hearing from multiple sources in the industry. Several major wholesalers have told their dealer networks that current inventory levels will be depleted within the next few days. Not because of panic buying, but because of steady, sustained demand that's been building for weeks. Once that inventory is gone, the next shipments aren't scheduled to arrive for several weeks. And there's no guarantee those shipments will be sufficient to meet demand. What does that mean practically? It means dealers are going to run out of popular products. It means premiums are going to rise as remaining inventory becomes scarce. It means delivery times are going to extend. And it means that if you're planning to buy physical metal in the near future, you might want to accelerate that timeline. I'm not trying to create panic here. I'm trying to give you information that most people don't have access to. The dealers know what's happening, the wholesalers know what's happening, the refiners know what's happening. But the average investor, the person who's been watching from the sidelines, they don't know. And by the time they figure it out, the easy opportunities will be gone. Think about the psychology of markets for a moment. Right now, most people are complacent. They see silver prices moving higher, but they're not alarmed. They figure they can always buy later if they want to. But what happens when the news breaks that physical silver is hard to source? What happens when people start calling dealers and hearing we're out of stock or delivery will be 8 weeks? That's when psychology shifts. That's when FOMO kicks in. That's when people start paying whatever it takes to secure metal. And here's the thing about silver specifically. It's affordable enough that regular people can participate. You don't need to be wealthy to buy silver. A few $100s gets you a meaningful position. But that also means when sentiment shifts, you can get a flood of retail demand that overwhelms the system. The market isn't that big. Global silver production is only about 1 billion ounces per year. Sounds like a lot until you realize that's less than $30 billion worth of metal at current prices. That's a rounding error in global financial markets. What happens if even a small percentage of global investment capital decides it wants exposure to physical silver? The market can't absorb that kind of demand without significant price appreciation. We're not talking about a 10 or 20% move. We're talking about the kind of move that changes the landscape of the precious metals market for years to come. The smart money is already positioning. You can see it in the ETF flows. You can see it in the COMEX warehouse data. You can see it in the premiums dealers are charging. The question is whether you're going to wait for confirmation, for the mainstream media to tell you what's happening, or whether you're going to act on the information that's available right now. I want to be clear about something. I'm not telling you to bet the farm on silver. I'm not suggesting you liquidate everything and go all in on precious metals. What I am suggesting is that you pay attention to what's happening in the physical market, that you understand the supply dynamics, that you recognize we might be at an inflection point where access to physical metal becomes more difficult and more expensive. The dealers I talk to, the people who've been in this business for decades, they're telling me this feels different. It's not just another spike in retail demand that will fade in a few weeks. It's sustained, broad-based buying from multiple sources. Retail investors, yes, but also institutions, family offices, high net worth individuals, people who understand markets and who are making strategic allocation decisions. And here's what really concerns them. The supply chain is fragile. It doesn't take much to disrupt it. A labor strike at a major refinery, a shipping delay, a change in export regulations from a major producing country. Any of these things could turn a tight market into a genuine shortage. And once that happens, once the perception shifts from silver is available if I want it to I better get silver while I still can, the dynamics change completely. We've seen this pattern play out in other commodities. Oil in the 70s, copper in the mid-2000s, lithium more recently. When a commodity that's essential to modern life hits a supply constraint, prices can move in ways that seem irrational until you understand the underlying dynamics. Silver isn't just a monetary metal anymore. It's an industrial metal that's critical to the technologies we're building our future on. And we might be reaching the point where demand simply exceeds available supply. The question you need to answer for yourself is this: what's your plan if physical silver becomes difficult to source? Are you comfortable waiting and hoping the situation resolves itself? Or do you want to take action while metal is still available at reasonable premiums? Because I can tell you from experience, once the crowd figures out what's happening, your options become much more limited. I've been through enough market cycles to know that opportunities don't last forever. There are windows where you can position yourself advantageously, and there are times when you're fighting the crowd for scraps. Right now, we're still in the window, but that window is closing. The dealers know it, the wholesalers know it, and now you know it. So here's what I'd suggest. Do your own research. Call some dealers. Ask about availability and delivery times. Look at the premiums being charged for different products. Talk to people who understand this market, and then make an informed decision about whether this is something you want to be involved in. Don't take my word for it. Verify what I'm telling you through your own due diligence. But don't wait too long, because if what I'm hearing from the industry is accurate, we're looking at a supply situation that's going to get worse before it gets better. And by the time it's obvious to everyone, the easy money will have already been made. For those of you who've stuck with me to the end, I want to offer you something exclusive. That free guide I mentioned earlier, the one in the description, if you check that out and mention you watched this entire video, you'll get access to a one-on-one educational web conference. No obligation, no sales pressure. Just a chance to talk with someone who can walk you through your options and answer your specific questions. This is only available to American retirees with at least $100,000 in retirement accounts, and it's completely free. Just mention you watched to the end. The bottom line is this: we're watching a supply situation develop in real time that could reshape the precious metals market. The physical metal is getting harder to source, premiums are rising, delivery times are extending, and the dealers who supply this market are sending clear signals that things are about to get more difficult. You can choose to act on that information, or you can wait and see what happens. But understand that waiting has a cost, and that cost might be higher than you think.